had a request to look at some inventory reconciliation questions. So this is where a stock take hasn't happened at the end of the year. It's been done a few days later, and we have to unravel the transactions that have taken place between the year-end date and the date that the stock was valued. So let's have a look at these. Jenny McGonigal calculated her inventory on the 8th of January 2023, and she valued it at 1,720. She had been unable to do this at her financial year end, which was the 31st of December 2022. She used this figure, the 1720, in her draft financial statement and calculated her profit for the year to be 56,900. Okay, so what we've got to do is work backwards from the 8th of January, where she had this valuation of 1720, to the 31st of December, which is her year-end date. And once we've established what the inventory should have been, we then need to adjust the profit for the difference. So further piece of information here is that Jenny marks up all of her goods by a uniform 60%. So this is markup by 60% to achieve her selling price. So let's just remind ourselves how markup works in terms of percentages. So sales minus cost of sales equals gross profit. Now, if we're working on a gross profit markup of 60%, we're marking up cost of sales, which is going to be the 100% figure, which means that sales will be 160% of any cost of sales. Now, you might be thinking, well, why are we worrying about this? Because inventory is always valued at the lower of cost to net realizable value. We don't need to worry about the sales price. But some of the transactions that have happened involve sales or sales returns. So these figures will be at the full selling price. So what we're going to need to do to get it back to cost is strip out the gross profit. Okay, so I'm going to suggest that we start with the inventory value. Let's pop that in here, use this as a working document. So the inventory value at the 8th of January 2023 was 1,720. And then we're going to take each of these transactions and think, well, okay, what would that have looked like at the 31st of December? So she's got sales that have happened between the 1st of January and the 8th of January. Those sales wouldn't have happened at the 31st of December. They've happened since then. So these goods have now disappeared from her inventory. We need to add them back, but not at the full selling price. We need to multiply them by the cost, which is 100, over the relevant percentage, which is 160, to get back to the cost price. Okay, so 1024 times 100 divided by 160 is £640. And we're adding that back on, if you remember, because she sold these since the year end. They hadn't been sold at the 31st of December. Okay, purchases since the 31st of December amounted to 540. So these are goods that have come into stock since the 31st of December, so they wouldn't have been there at the year end. So we need to take those away. Now, purchase returns, she's returned those £17 worth. This is both at cost. So the purchase returns, £17, wouldn't have happened at the end of the year. So they're going to need to be added back because they would have still been in stock at the end of December. And then finally, we've got sales returns. Now, because they're sales returns, this is at the full selling price. So we need to trim that back to find the cost price. So 96 times 100 over 160 means that the cost price of those is £60. And we're taking those away. Those goods have come back into stock since 31st of December. They weren't there at the end of the year. Okay, so we can then add and subtract to find the value at the 31st of December 2022. So 1720 plus 640 minus 540 plus 17 minus 60 means that the value of her inventory was 1,777. Now the difference is that it is now £57 higher than it was when she calculated her draft profit for the year. So the corrected profit is going to be the 56,900. If inventory increases, then so does profit. The reason for that is that if inventory is higher, the deduction at the bottom of cost of sales is going to be higher. That means cost of sales is lower. Therefore, the gross profit and the profit for the year is going to be higher. The value of the assets is also higher, so that would be the top half of the statement of financial position. So that means that her corrected profit is £56,957. Okay. Let's look at another one then. David Parker was unable to count his inventory at his year end, which was the 31st of July 22. He was able to count it though on the 9th of August 22 when it was valued at £2,000. Using this figure, he obtained a draft profit of 42,870, and David marks all goods up by 70%. So let's just do our little calculation here. So if we're working with markup The markup is 70%. Cost of sales is always 100% when it's markup. And that gives us a sales percentage there of 170%. So if we're trying to strip out the gross profit from a sales figure, we're just going to need to multiply it by 100 divided by 170. So always divide by the relevant percentage and multiply by the one you want to find. That's the rule. Okay, so again, let's start with the inventory value at the 9th of August 2022. Make sure we pick the right figure there, £2,000. And then we're going to work through these, adding and subtracting, just as we did with Jenny McGonigal a minute ago. So the sales amounted to 1904. So if we multiply that by 100 over 170, that gives us a figure of 1120. And we're adding that back because those sales hadn't happened. The goods were still in stock at his year-end date. Purchases amounted to 1560. Well, he wouldn't have had those in stock at that time, at the year-end, so we're going to take those away. Sales returns amounted to 170. So if we times that by 100 over 170, I don't think we even need a calculator for that. It's going to give us £100. And we're going to need to take that away because those returns wouldn't have been made on the 31st of July. They wouldn't have been there. And then finally, the purchase returns here amounted to £40. So we're going to need to add those back because we wouldn't have returned them, or he wouldn't have returned them at that date. They would have still been there. Now, there's one final twist in the tale for David. He said that goods sent on sale or return during July amounted to £510 at selling price. Now, if you remember, goods sent on sale or return usually have not been included in the inventory, so it doesn't really explain it very explicitly here, but I'm going to assume that that's what the person who wrote this question meant. It wasn't me. I need to credit my ex-colleague who's since retired, Jeff Smith, for that one, but the goods sent on sale or return, we need to, if they've been included as a sale, they'd need to be removed from sales, but we need to add them back at the cost price. So again, we're going to multiply that by 100 over 170. So 510 times 100 over 170 is £300. And we're going to need to add that back to inventory because if it was sent to a customer, it's probably not been included. So the value at the, what was his date, 31st of July 2022 is going to be £2,000 plus 1120, where we've added back the sales, minus 1560 for the purchases, minus 100 for the sales returns, plus 40 and plus 300. So the value of David's inventory now is £1,800. He'd valued it at £2,000. So the difference, if the inventory goes down, so does profit. So the correct profit figure is 42,870 minus the difference in the inventory valuation gives us a profit of 42,670, doesn't it? So Pat Nicholson was unable to count her inventory at her financial year end on the 30th of June 2022. When she did count on the 5th of July, she valued her inventory at 3,565. Using this figure, she was able to determine her draft profit as 180,564. Now, this time it tells us that Pat works on a gross margin of 50%. Now, remember, with margin, it's slightly different. So the 100% figure is the selling price. The cost of sales is what's left after you've deducted the margin 50%. That means that cost of sales is also 50%. So be careful with this one. We're not working with a figure bigger than 100%. Margin relates to sales, so that's your 100% figure. Take off the gross profit margin. I'll tell you what the percentage is for cost of sales. Okay, so we're going to do this in exactly the same way. So value at the, not the 30th of June, when did she value it? 5th of July was 3,565. Sales that have happened since the end of her year, 30th of June. So we need to add them back because they wouldn't have happened at the end of the year. So sales amounted to 2,360. So we're going to multiply that by 50 and divide it by 100. So we're dividing it by 100, that's the selling price, and we're multiplying it by 50, the cost of sales. So it's basically half, isn't it? 2,360 divided by 2 is 1,180, and we're going to be adding that one back. And then we've got the purchases that amounted to 980. Well, she hadn't purchased those at the end of the year, so that needs to come off. Sales returns are 130. If we times that by 50 over 100, in other words, halve it, that's £65. We need to take that off because those returns wouldn't have been made at the year end. Purchase returns amount to 58. Well, let's add those back on because you hadn't returned those at the year end. And then we've also got a sale or return thing here. Goods dispatched on sale or return during June amounted to 1420 at selling price. So apologies, I did a bit of a blooper here. So what we're multiplying this by is 50 over 100. The goods dispatched on sale or return, 1420 times 50, which is the cost of sales percentage, divided by the 100, which is the selling price percentage. That gives us £710 to add back on. So when we add that back on, that means that the value on the 30th of June 2022 is 4468. So what I've done, just add and subtract all of that list of figures, taken off the 3565, which was her original inventory valuation, which means that the inventory is actually increased in value by £903. So an increase in inventory valuation means that we're going to get an increase in profit. So when we add that back to the original figure, her draft profit 180,564, we get a total of 181,467. That's her new profit. So hopefully that's explained it. Thanks very much for watching. Don't forget to like and subscribe.